Well, hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. We're going to be talking about partnership accounting. We're going to be talking about different types of organizations, how they're structured, but we will focus, of course, on partnerships. Partnerships are when we have two or more owners of a business. Two or more owners of a business. That's a partner. Uh, and it is defined by the percentage of ownership. And that's what we're going to be focusing on with respect to accounting for partners. It is the percentage of ownership of each partner in the business. And a lot of that has to do with the assets they brought into the business and how those assets are being utilized. But they also has to deal with a percentage based off of stock that they have in the business. So there's a couple ways of accounting for it, and we're going to discuss that. We'll also talk about how they're formed, how they're started, what happens when a partner comes in, what happens when a partner leaves, and how all that works. And for those of you who are in business and you're thinking about forming a partnership, be very cautious around how you form the business, because you want to be very clear about the percentage of ownership for each partner. You also want to be very clear on what it is that those partners are bringing into the business with respect to cash or other assets they're contributing to the business to get it started. And you want to make sure that your company charter identifies all those things. When we form a partnership, we look at who's in it, how long they're in it for, and a lot of this is outlined in the partnership agreement. The partnership agreement is a legally binding contract between the partners that identify exactly which each partner is agreeing to, for how long, what they're bringing in. It documents pretty much the formation of the partnership. Well, partnerships don't last forever. There's a limited life cycle to a partnership. Why don't they last forever? Because people die, or they retire, or they sell the business. It's limited. Yeah, that's partnership. Partnerships, and here's the not so great part about a partnership, is called unlimited liability. Unlimited liability. That's why I strongly encourage that if you're looking at a partnership business, that you do what's called a limited liability company partnership. Limited liability company partnership, LLC. The reason why partnerships have unlimited liability is because in a partnership that is not formed as an LLC, they are exposed to lawsuits, to loss, to whatever, unlimited. That means that if you are in a partnership agreement and it's not a limited liability, and if you get sued by an angry customer, by whatever, you are liable all the way through your personal assets, your house, your car, anything else you own. So it's very risky. That's why I always encourage, if you're ever going down this road, to please, please, please do an LLC partnership if you're going to do it. Co-ownership of property. Partners bring in assets to the business. They contribute cash, they contribute capital, like property, plant, equipment, etc. Both owners or all owners have some co-ownership of property. Partnerships also have mutual agency, meaning that the business can act on its own based off of the partnership agreement. Taxation is typically shared across partners, meaning all the partners are responsible for paying the business's taxes. And partnership is voluntary. You're not forcing somebody to be in a partnership. This is what I was talking about, LLC. LLC partnerships are great, but they can be dangerous because of the liability. Liability means that you're liable should something happen. That's liability. You could get sued. That's liability. You can lose your investment. That's liability. You can lose your house. That's liability. Okay. Liability in the formation of a business is super risky. So that's why I always recommend that if you're ever going to go down this road, LLC might be more for you. Partnerships, you can do a limited partnership or a limited liability partnership, absolutely. But I will say that oftentimes the partners have some personal liability associated with them. Sometimes it's protected through, like, for example, through the limited partnership. The limited partners have no personal responsibility beyond the investment into the company. That may be true to an extent, but they still might be liable beyond that based off of the agreement. Limited liability partnership, in most states, all partners are liable for the partnership debts. And then the other two types of business are S corporation, where it has the same liability as a C corporation, but it's treated differently for tax purposes. And with a limited liability corporation, there are limitations to the extent of liability, meaning typically the liability ends with the corporation. It does not go onto a personal liability. That's why I always like the LLC. Personally speaking, I like the LLC formation. It's because you want to limit liability as much as you can. You really do. Taxation. Taxation is another reason why partners might choose to form a different type of business because of the way the business is taxed. The only exception here is the C corporation. The C corporation, the business is taxed as its own entity. It's its own entity, meaning that whatever income the business brings in, it is not the income of the individual owners. It is the income of the business. The business pays its own taxes. That is C corporation. The rest of these, it's what we call a pass-through entity. A pass-through entity simply means that you, the individual owners, are responsible for both the income and the loss of the business. Pass-through entity. Now, of course, at the beginning of any business, there are some initial journal entries that need to be established. These journal entries help to set up and establish the business. It includes things like the payment of licensing fee, the setting up the owners or partners' capital accounts, representing assets and liabilities brought into the business by partners. It helps to establish market value, things like that. These are all the initial general journal entries that we put into the accounting system, like QuickBooks or whatever, to establish the business. to get it started. So I'm going to run through a couple of examples, but I'm going to try to stick with this one because it makes logical sense. So here we have a business. And in this business, we have two individuals that are starting their own business. It's called boards, B-O-A-R-D-S. And basically this business was formed by these two individuals for boarding. That's what I call boards. Boarding, of course, is when they are housing typically livestock or pets or, like a dog kennel or a pet hotel or horse stables or, etc. Those are boarding facilities. And so these two partners started the business. They brought in some cash. They brought in a building and a loan. Okay. And there was a separate investment by the other partner. So one partner, Zane, Kayla, she brought in $7,000 in cash and a building and a loan. So she brought in cash, a building, and a loan. So the first transaction we need to do is to establish her investment into the business. So we have to identify what it is that she brought in and technically out with a loan, and establish her capital account. So here's how it works. We debit cash because cash came into the business from the investor, from this partner. So she brought in $7,000 in cash. So we debit cash, $7,000. We debit building, boarding facility, $33,000. She brought in a building into the business. She also brought in a loan. So we credit note payable, $10,000. So she brought in a loan, right? And then we credit her capital account. Remember, the capital account is equity. It's an equity account. Yeah? And we're going to credit that $30,000. Now, here's how we got $30,000. She brought in $7,000 in cash. She also brought in $33,000 worth of building. So that's what, $40,000, right? So she brought in $40,000 in assets. She also brought in $10,000 in liabilities. Now, remember the accounting equation. Assets equals liabilities plus equity. We can rewrite that accounting equation to find equity. And that is assets minus liabilities equals equity. Assets minus liabilities equals equity. And since capital is an equity account, and it's the difference between $40,000 and $10,000, we're going to credit the capital account to increase the capital account by $30,000. So in this journal entry, the first one, 40,000 equals 40,000. Make sense? So far, right? You all can still hear me. I'm not on mute. You guys are awake, mostly. I know. It's Monday. It's a long day. Okay. All right. Okay. The second transaction is to represent the investment from the second partner, Mr. Perez, Hector Perez. Hector he brought in cash, just cash investment. So debit cash 10,000, credit capital 10,000. What this does is it increases our cash by the investment amount, and it increases Hector's capital account, which, as we know, is an equity account. So that first set of transactions represents the establishment of the partnership. It represents what they brought in, what they're contributing to the business. We need to account for in business. We need to account for what the partners, owners, are bringing in and out of the business. This would include withdrawals. An owner's withdrawal, or partner's withdrawal in this case, is debited to their own separate withdrawals accounts. In other words, sometimes the owner wants to pay themselves. That's normal. You should want to pay yourself if you're an owner. So we need to debit withdrawal, your name, credit cash. Sometimes partners will bring stuff into the business. But sometimes they'll also desire a share of net income from a payment at the end of the accounting period. So we would credit or debit, depending on the situation, net income to their accounts at the end of the accounting period based on their shares. Partners, withdrawal accounts are closed at the end of the accounting period because of temporary accounts. And I think we remember talking about withdrawals briefly. We talked about withdrawals when we talked about the retained earnings report. And I remember we talked about withdrawals at that point. And withdrawals, as you know, are temporary accounts that are closed at the end of the accounting period. So let's continue forward. It's important that we contribute income or loss to the partners. And they're divided based upon a certain agreed upon ratio. Typically it's based off of their contributions to the company when the company was first established. Because owners are not paid a salary. Owners are paid based on profits and losses. And it's based on a certain agreed upon percentage. The partners typically also agree on how frequently they get paid based off of the income or loss. We look at things like stated ratios, capital balances, services capital and stated ratios. Basically, these are methods for allocating the income or the loss to each partner. It's usually, like I said, it's usually agreed upon based off of what they brought into the company. So in our example, with our two partners here, Kayla and Mr. Perez. So Hector. So Kayla, she brought in quite a bit of stuff into the company, right? She brought in 10,000 in cash. She brought in 33,000 or 7,000 in cash and 33,000 in a building, right? It's quite a bit. So she brought in the building and some cash. And Hector, he brought in $10,000 in cash. So the partners, they agreed that Kayla, she will earn 2/3 of the business, and Hector will earn 1/3 of the business. So at the end of each month or each year, whatever, the partners will distribute the profit, right? Net income. So after we close out our temporary accounts, income statement accounts, we close those out to income summary. Remember, that's the closing process. After we've closed it out to income summary, we distribute the income summary to the partners' equity accounts. So we debit income summary and we credit each partner based on their percentage of ownership. Kayla owns 2/3 of the business. So 2/3 times 60,000, that's 40,000. Hector owns 1/3 of the business. 1/3 times 60,000, that's 20,000. So this is to represent the distribution of net income summary, to the partners' equity. In their partnership agreement, the partners agreed to allocate profits and losses based on their beginning capital balances. Kayla brought in $30,000 worth of assets. $7,000 was cash, and 33. I'm sorry. Yeah, 7,000 was cash, and 33 was a building, minus the 10,000 that she brought in from a loan. So her balance is 30,000. 30,000 is what she brought into the business. Hector brought in 10,000 in cash. Kayla has 2/3 of the business, 75%. Hector has 1/3 of the business. Yeah, 25%. So 40,000 total, 100% of the ratio, 75/20. The income from at the end of December was 60,000. So how do we allocate it to each partner? 60,000 income times the percentage of ownership. Kayla owns 75%. 60,000 times 75% is 45,000. 25% of 60,000 is 15. That shows the total allocation. The journal entry we make at the end of the year is debit income summary, 60,000. We got that from that income. We credit, after we went through the closing entries, remember? The credit goes to Kayla, 45,000, and to Hector, 15,000. What if they had in their partnership agreement the following? Kayla receives 36,000 annual salary, and Hector receives an allowance of 24,000. Each partner is allowed annual interest of 10% based on their beginning capital balances. Any remaining balance of income or loss is allocated equally. And let's say at the end of the year, they had a net income of 70,000. So based off of this information, we can reformulate what's left. So here we go. So Kayla, she has a salary of 36,000. Perez, he has an allowance of 24,000. The net income was 70,000. So after I pay both of them, I'm left over with 10,000 bucks. We have interest. Go back, because I always get confused about the interest. The interest was 10% based on their initial capital investment. Remember, Caleb brought in 30,000 in assets. Oh, net assets. So 10% of 30,000 is 3. Hector, he brought in 10,000 in cash. 10% is 1,000. So I'll pay them some interest. 3,000 to Kayla, $1,000 to Hector. Now after I paid the interest, I got 6,000 left. Now according to their agreement, whatever was left was supposed to be divided equally. So 3,000 and 3,000. And this represents the income to each partner at the end of the year. Make sense so far? We're still good? You're okay? You're feeling all right? You're still awake? You eating dinner? What's going on over there? Somewhat? Amy, what's going on? You doing okay? You getting it, right?
I'm okay until we got to the 10%, and now it's 70K instead of 60K.
Oh, sure. Yeah. It's just because we have a different year. We're in a different year. So here's where that data came from. So based off of this example, we have a set of conditions. And these conditions are outlined in the partnership agreement. It's a document that they both agreed upon when they first started the business. So now we're getting more information. Right? And the first thing is that they're basically giving themselves a salary, which is fine. They can do that. So Kayla, she's getting 36,000. Hector's getting 24,000. They also said that they're going to give themselves interest based on the beginning capital balances, meaning interest based off of what they brought into the business. Now, Kayla brought in 7,000 in cash and 33,000 in a business and a building, but she also brought in a $10,000 loan. So Kayla brought in a total of $30,000 worth of usable assets. Hector brought in $10,000 in cash. So that's where we got the interest amounts. $3,000 in interest went to Kayla because it's 10% of the 30,000 that you brought in. And Hector, he got $1,000 interest because it's 10% of the 10,000 that he brought. And then whatever's left at the end of all these distributions gets divided equally. And it says that in this particular year, because it's a different example, our net income was 70,000 from this particular year. So we start off with net income, and then we start subtracting out all the distributions. So the 70,000 minus the salaries paid out, 36 to Kayla, 24% to Hector. That gives us 10,000 left over. And then with that 10,000, I'm going to pay them interest. 3,000 went to Kayla because she brought in 30,000 in usable assets, and Hector brought in 10,000 in usable assets. So 30,000 times 10% is 3. 10,000 times 10% is 1. So that's where we came up with those interest amounts. And after I paid them the interest, I'm left with 6,000. And according to that agreement we just looked at, we divide whatever's left over equal. And that's how we, how much we're paying each partner based off of that information. Amy, does that help to kind of clarify it?
Yeah, it did. Thanks, Professor.
Awesome. Hey, my pleasure. I appreciate it. Great. Very good. All right. Now, let's say another year goes by, and we have a different net income. Sure. Every year is different. So another year goes by. Now we have a different net income, and it's a little lower. So let's say, this particular year didn't go so well. Yeah, didn't go so well. So they only earned 50,000 net income. Oh man, that's a little low. So let's say the other parameters are the same. So Kayla still gets her 36,000. Hector still gets his 24. That's obviously more than the 50. Right? So now I'm negative 10. But I still got to pay these guys these two people interest based off of their initials, right? Based off of what they brought in. So I still got to give Kayla 3,000. I still got to give Hector 1,000. So I still paid them, but according to that awesome document that they signed at the very beginning, the partnership agreement, it said that they must equally share the income or the loss. So, in this case, guess what? There were some losses here. So, after I paid their salaries and their interest, now they owe the company a total of 14,000. They owe each of them owes 7,000 because it's equal sharing in the income or the loss. So the total income to each partner is substantially lower. Kayla got 32,000 and Hector got 18 in this particular year, in this particular example. Make sense? Good. Okay, cool. Thanks. Okay. So some more data. The company. Let's take a look at the equities, the statement of equity. Now I got Kayla, I got Hector. So at the end of 2019, Kayla, she took $20,000 out of the partnership in cash. And Hector, he took $12,000 in cash. Okay, that's fine. Yeah, no problem. The net income for the year was 70,000. So the net income was 70,000 for 2019. So if I look at the totals here, 42,000 of that 70 went to Kayla, 28,000 went to Hector. Minus their withdrawals. Kayla took an extra 20,000, Hector took an extra 12,000. That, of course, brought my equity into the negative by 32,000. So the contributions of each partner after everything that happened here, Kayla ended with 52,000 and Hector ended with 26. You have 78. Now what if? What if? What if they wanted to change the partnership? And this happens a lot too. You know, this happens a lot. Small partnerships change. They dissolve. They form new partnerships. They exchange partners. Yeah, you know, that's business. When this happens, we have to identify a new partnership. Let's say we have a new partner that comes into the business. We form a new partnership based off of this new partner. And the new partner acquires some interest in the company by purchasing the company from the other partners or by investing assets into the partners. Those are the two ways that a new partner could acquire interest into the company. So let's say a new partner wants to purchase partnership interest directly from the existing partners. Then the new partner will pay cash directly to those existing partners, not to the partnership. In other words, they're just basically buying a small piece of the pie from the existing partners. That's called purchasing partnership interest. That's one way of doing it. So here comes partner number 3, the new partner, Terrell. Now I got Kayla. She had 52,000 at the end of 2019. I got Hector. He had a balance of 13,000 at the end of 2019. And the beginning of 2020, I got a new partner, Terrell. Terrell decided that, hey, I want in on this business, so I'm going to purchase some interest from Hector. So Terrell goes, hey, Hector, I want to buy into the business, but I want to buy into it from you. And Hector agrees, says, okay, great. How much of the business, you want to buy from me? So Terrell goes, hey, I'll buy $13,000 worth of the business from you. Okay, great. So we have a new journal entry. So we debit Hector's capital account by $13,000. And we credit Terrell's capital account by $13,000. What this does is it represents the transfer of $13,000 of ownership from one partner to another. Now remember, when a new partner comes in and they purchase partnership interest, that cash that Terrell used, it went right to Perez. It did not go into the business. It went right to Perez for the purchase of partnership interest. Now let's say Terrell, instead of buying into the company like that, instead of, let's say he decided, hey, on second thought, I don't want to buy, Terrell says, I don't want to buy Hector's shares. I just want to get into the business and I'll contribute new assets. I'll bring in some stuff into the business, which is fine. That's why he wants to do it. Totally cool. We could do that. So Terrell goes, okay. So based on that, I should see an increase in my assets. Of course he will. Of course he will. So Terrell says, hey, instead of buying those shares from Hector, I'm simply going to invest into the business using cash. So, which is totally fine. Terrell can totally do that. So here's here's based off of this. Here's what we got. Kayla, she's sitting at 52,000. Hector, he's sitting at 26,000. Terrell, sitting at 22,000. So 22,000. That's new allocation because Terrell's new, so he's just pumping cash into the business. So debit cash 22,000. Credit Terrell's capital 22,000. Represent admission by Terrell as a new investment into the business. So now Terrell's a partner, and we got Kayla, and we got Hector. So what about bonus? Bonuses get paid out based off of the partnership agreement. But now that there's a new partner, bonuses might be granted to the new partner. But if the company needs the cash, or if the new partner has other exceptional talents, then maybe that new partner, Terrell, might forego the bonus. And maybe it might get worked out in a new agreement. But bonuses can be, a little tricky from that regard. So let's say that just as Terrell was accepted into the partnership based off of his investment, Terrell will receive 25% interest in the new business. Any bonuses that happen before the existing partnership is shared equally. So, based off of that, there is $42,000 worth of investment that Terrell paid into the business. And Terrell owns 25% of the business, so Terrell will get a portion, and then the existing owners will receive a small bonus, $6,000 each. So it's the cash minus Terrell's investment, and then that balance divided by 2, 6,000. So basically, Terrell paid a small bonus to the existing owners to get into the business and to get his 25% of ownership. Sometimes the new owner, Terrell, he might get a bonus. Again, all depends on the form of ownership, the partnership agreement. So let's say he gets a new bonus, right? He cut based off his 25% ownership, which is awesome. Here's how that would work. If a new owner gets a bonus, we debit the cash, we debit the paid-in capitals, and we credit the difference to the new owner for the admission of the new owner and the bonus that he's receiving. But what about when owners want to pay themselves? It's important to pay yourself, especially as an owner. You still got to collect something for you to live on. So that can happen in two ways. Number one is one of the partners can sell partnership interest to another person. That happens. It's like, I'm going to sell some of my shares in my business. That's one way of doing it. The other way is the partnership can distribute cash and sometimes other assets to the partner wishing to withdraw cash from the business. And sometimes a partner might say, hey, you know what, I'm done. This was a lot of fun, but I'm done. I want to get out of the business. And the same concepts apply, when it comes to withdrawal. So here, let's say one of the partners is done, saying, you know what, it was a good run, I'm out. So Hector says, hey, uh, I'm out of here. This has been great, but I'm done. I'm tired. I want to do something else. So we go, okay, all right, Hector, let's look at what everyone's got. So Hector, he had 38,000 balance in his account. Uh, uh, she had 84,000, and the other partner had 38,000. And based off of this withdrawal that Hector's leaving, the partners share income and loss equally. So Hector should be receiving the 38,000 of cash when he leaves the partnership. So we debit Hector's capital balance, 38,000, and we credit cash, 38,000, to pay Hector the cash because he's leaving the business. He's done. He's out. But what if Hector is due a bonus as well? That bonus, according to their partnership agreement, gets distributed to the remaining partners. So we debit 38,000 capital. We credit cash 34,000. That's what Hector's getting. That's what's left because of the bonus. And the other two partners receive that bonus. That's just part of the agreement that they signed. Sometimes the partner that's leaving could get the bonus, right? Again, all depends on that partnership agreement. Be careful with what you've signed. Make sure you read all the details. So Hector, he had 38,000, and so he's also going to receive that part of that bonus. He earned it. So he's going to receive 1,000 of that bonus from Kayla and 1,000 from Terrell. So Hector's going to walk away with 40,000 in cash. That's withdrawal plus the bonus from the partners. What happens when a partner dies? You know how life is. So one of the partners dies. That's sad. A deceased partner's estate is entitled to receive the equity. It's just like when anyone dies. Besides it being sad, there's always assets involved and liabilities involved. So the estate is entitled to any gain or loss, and the books are closed out at the end of the accounting period. And any remaining assets are based off of market values. So that's one thing that. What if the partnership liquidates? The partnership dissolves. They said, hey, you know what? This business ain't working for us. Let's close it up. Okay. So when there's liquidation, there's a sale of non-cash assets. Gain or loss on the liquidation is recorded based off the partnership agreement. all the partners' liabilities are paid out, and then anything that's left over is distributed to the partners based on their capital balances. Sometimes businesses run out of money. We call that capital deficiency. Sometimes that deficiency is a result of liquidation. So I'm going to show you an example of no capital deficiency, and I'll show you one with capital deficiency. This first example, the three partners decided to liquidate the business. They're going to end the business. Whatever's left, they'll pay it out. They only had one liability account remaining of $20,000 in accounts payable. So this is their balance sheet. They got $178,000 in cash, $40,000 in land, accounts payable at $20,000, and of course there are three capital accounts. So based off of that information, the first thing they're going to do is they're going to sell the non-liquid assets. So they're going to sell the land. They sold it for $40,000. Now remember, at the very beginning, Kayla, she brought in that land with 30 at a value of $33,000. So she sold the land for $40,000. There's a gain, sold for $40,000. Well, it sold for $46,000. The land was worth $40,000 at the time. So there's a gain of $6,000. They brought it in cash, $46,000. The land was worth $40,000. The gain is $6,000. So based off the partnership agreement, the gain from the liquidation is distributed equally among the three partners. Each partner, based off of their balances and the increase in the gain on the asset from the sale of the asset, their balances are then paid out cash, distributed to all the partners after they paid the accounts payable. Paid bills. Sometimes there's not enough money when there's final cash distribution during the liquidation stage of a business. This happens for a various number of reasons. Too many withdrawals of cash. There's too many losses during the accounting periods. Businesses run out of cash for various reasons. So it's up to the partners to pay that deficiency of cash. And it's based off of, according to their partnership agreement, the final distribution is based off of the capital balances. So Kayla had a balance of $19,000, Hector had a balance of $8,000, and our newest partner had a balance of negative $3,000. So Terrell. So Terrell, unfortunately, because he had a negative balance of $3,000, he had to pay that amount back to the company. So Terrell paid that deficiency back, and then the remainder went back to the other two partners. Sometimes a deficiency can't be paid for whatever reason. So maybe Terrell didn't have $3,000 in cash sitting around. That's totally normal. So so Kayla and Hector, they got together and they said, all right, well, let's take care of this deficiency. So it came out of their capital, went to Terrell's capital, and then any remaining balance went to the other two partners. Now, would it be a chapter if it didn't end with a ratio? So here's a ratio. This ratio is called the partner return on equity, and it really does measure the percentage of ownership with respect to their total equity balances. So we take the partner net income divided by the average partner equity. We find the average partner equity by taking the beginning of year plus the end of year divided by 2 to find the average partner. That, my friends, is the conclusion of our discussion on partnership accounting. Are there any questions, comments, or concerns about partnership accounting? Y'all good? Okay, great. Now, a couple of real quick housekeeping notes. We are, believe it or not, we're in week 6. The time is really flying by here. So module 3, week 6. Yeah, I know, right? It's going by so quick. Week 6, chapters 11 and 12 are what we just covered. Your assignments for Sunday. You have a chapter 11 discussion board. Oh, I know those discussion boards. Dr. B, how dare you make us interact with each other? That's what discussion boards are all about. This is a great class. A class is a group effort. So please, talk to each other. Have some fun with it. So painful. How dare I make you all be like a class and talk to each other? Yeah, I know, right? I'm just trying to build teams here. Okay, so chapter 11 discussion. So here's how it looks. Some of you are already participating in this, so thank you. Yeah, that's very nice of you. Oh, wow, look at that. That's beautiful works. Kelsey, wow. Look at that. That's amazing. Okay. Now, Kelsey did a very wonderful job. Now, here's what she's got going on. She's got 2 full paragraphs, and she even has a reference. That is fantastic. Oh, my goodness. Now, to me, that's full credit right there. But the only thing that Kelsey has to do now is respond to 2 of her classmates with full paragraphs, okay? And then she'll get the full 5 points. So, here's how it works. You're going to read this question. You're going to describe the importance of maintaining accurate payroll records. That's a very vague statement, okay? So please, use outside research. You can use the internet. You can use your textbook. You can use whatever you like. But again, I'm looking for full paragraphs, including citations references. After you've done your full response, just like what Kelsey here did, because hers is very well done. I see full paragraphs. I see reference. So after you do yours, similar to hers, then you'll respond to 2 or more of your classmates with full paragraph responses. Once you've done all that by Sunday night, you should get full credit. Okay. Now remember, 1, 2, 3 sentences? No. But 1 sentence is not a response. 2 sentences, not a response. I'm looking for full paragraphs here. Okay? So don't say, oh, that's nice. Oh, good job. That don't count. Okay? So please, I know it's painful to interact with your classmates, but just please do it. Just please do it. So that's your chapter 11 assignment. Then you also have chapter 12 quiz. Remember, with all quizzes and homework assignments, you have 2 attempts. 2 attempts, the highest grades take it. Not satisfied with your grade, right? It's all about practice. And I have these cute little exercises for each chapter to help you to better understand the content and to be able to apply it. It helps us learn. Are there any comments, questions, or concerns about what's happening this week? Y'all good? Okay. Now, as always, in your chapter 11 discussion, chapter 12 quiz due Sunday night. And as always, I want you all to please stay safe. Wash your hands and do the right things. And if you need anything in the meantime, you know you could scroll up here and click this button that says office hours. You can also get some tutoring with Dr. Remy. You can always email me, call me, set up office hours. Hear from you 100% of the time. I want to say thank you all so very much for your time today. I appreciate all of you. Please stay safe, wash your hands, do the right things. I'll see you all again, same time, same channel next time, 5:30 on Monday. I'll catch you later.